Good afternoon. Thanks for tuning in. You're watching Countdown on Bloomberg Went Live, India's first digital live streaming business news service. I'm Navneet Saluja D'Souza. Well, these are the top headlines that we're tracking at this hour. Sentiment in the equity markets is weak this afternoon. The Nifty has fallen below the 11,900 mark. Banking and financial stocks are underperforming. Indiabulls Housing continues to remain the top loser on Nifty. The stock is now down 15% in the last two sessions. Yes Bank is also among the top losers on the Nifty after Moody's placed its rating under review for a downgrade. And PwC resigns as the statutory auditor for Reliance Capital and Reliance Home Finance, flagging concerns over some transactions. Both stocks are now trading with cuts of over about 4% each. Good afternoon, Neeraj. Well, I think the Indian markets have been tracking the global cues. Asia closed weak and the European markets have also opened in the red. Nifty is finding huge resistance around the 12,000 mark.
Yeah, and maybe with reason as well, Navneet. No big reasons for us to do well as well. And that's the other key thing. And I'm sure we'll talk about the derivative setup in detail because remember in the morning in the trade setup I was talking about how while the varied range is between 11,500 and 12,500, there are some interesting build-ups happening in other strikes too. But down in the session today, 11,890 for the Nifty Bank, the principal culprit, down nearly 300 points and trading at about 30,965, so below 31,000 for the Nifty Bank and trading in around the lowest point of the day as well. The market breadth, vulnerable today. It's probably not as bad as it has been in the last couple of days, wherein it's been clear 2:1 in favor of the declines. Today, maybe marginally better than 2:1, but still in favor of the declines and widening as the day is going by. So let's see what happens during the course of the next 1.5 hours. The heat map should come up on your screen. It was a sea of red when we started off, very little green. In fact, the quantum of green has probably inched up a little bit. And the quantum, the gains on the stocks as well, the likes of Tata Steel, GAIL, etc., much higher. When we started off, the top gainer was up about 1/3%. So yeah, some gains, but the losses are more pronounced. Indiabulls Housing, another 8.5, 9% lower in the session today. I tell you, these are really tough times for that particular group of stocks. It's not just Indiabulls Housing. The other group stocks as well have taken it on the chin. Yes Bank, another 3.5%. One more independent director out from the board. Bharti Infra, 2.5%. And IT's taken a bit of a back seat. You got to see autos, and autos are looking wobbly today. So Maruti is weak. Bajaj Auto, Hero MotoCorp, all of them have looked slightly weak in the session today. So the high beta rate sensitives are down, and you know what's contributing to the index fall? HDFC Bank, both the twins down about 0.75%. In terms of contributors, they would be right up there on the losing list. Even if Indiabulls is down about 8.5%, I would reckon that the HDFC twins would be there on the contributors list. But let's bring up the mid cap and the small cap movers as well very quickly before we look at the more liquid universe, which is the F&O universe. So DHFL, and on good reason, is up about 3%. They have repaid the dues on the NCDs, and therefore 3 days on a trot now, DHFL is in the green. And then there are a few others, but it's not really about what the gainers are doing. I mean, Sterlite Tech up on the 1.5%. The power companies are doing well. Look at the losers. So Indiabulls Group right out there. So Indiabulls Ventures down on the 5.5%. Reliance Capital on the 4%. Down. Edelweiss is down about 2%. And similarly in the small cap space, you will see some vulnerable names looking slightly wobbly. So Jain Irrigation, another 6.5%. Indiabulls Real Estate, another 3.5% as well. So no deal notwithstanding, the Indiabulls Group is facing a bit of a cloud. That arguably the last 2 days has been amongst the top losers along with the ADAG Group. Navneet, looks wobbly, and the volumes, yesterday's volumes are a bit lower, but today the volume activity too seems to be a bit higher.
That's a very pertinent point, especially on the cash side, Neeraj. Last 2 days, there's been lack of participation because the cash turnover has been below the mark of 30,000. But volumes are expected to pick up at least today because tomorrow is also the weekly options expiry for the F&O. As of now, F&O turnover is already clocked close to 8 lakh crore on NSE. Let's just look at the futures, how they are performing. The Nifty futures, no major build-up, and that's been the trend, let me tell you, in the last few days. We've not seen any major positions coming by when the Nifty was also scaling higher, which means that no fresh long positions are being taken. In fact, the existing longs are cutting their position as and when the Nifty reaches the 12,000 mark, and that was exactly the case in yesterday's trade as well. For Bank Nifty, which I think for half the session yesterday it was outperforming, but then that also gave up steam, and today it's down nearly 1%, underperforming Nifty, 9% higher when it comes to the OI build-up. And yesterday also the futures closed at a discount of about 18 to 20 points. They continue to trade at a discount as we speak. India VIX, though the markets are lower, but VIX has already fallen from those highs of 28 to 29, which we were witnessing before the election results. So right now about 14.4. How's the positioning looking like? So maximum open interest on the call side remains the same. It is still at the 12,000 call. On the put side, it shifted to 11,900 yesterday, but it's back to 11,800 because you're seeing unwinding. Actually, with markets falling today, the put writers are running for cover. The 11,800 as well as the 11,900, followed by the 11,950. All these three strikes have been witnessing unwinding in open interest. Whereas if you look at the call side, writing clearly visible at three strikes, 11,900, 950 and the 12,000 strike. The range is very narrow for tomorrow, 200 points, 11,800 to 12,000. But still on the downside, what levels one can watch out will be the recent lows. If you can just pull up that plate, yesterday's low of 11,904 has been breached in today's session. The next level on the downside can probably be the 11,871 and then the 11,769, which is also somewhere about the 50-day moving average. In terms of stock futures, India Bulls Housing, we've been highlighting that counter. Fresh shorting was seen yesterday. Today also shorting is visible with regard to the open interest going higher. It remains the top loser on the Nifty. In fact, it's falling on very high volumes on the cash side as well. The AV80 function of Bloomberg will clearly show you that the white line is projecting today's volume. Compare that to the average volumes of last 20 days, which is being projected on the blue line. The other one is Tata Steel's. Tata Steel. The steel counters have been holding about today. This particular stock is up nearly 4% this week. It's trading around its 100-day moving average, and we've seen some bit of long positions also coming by. And if you see the chart, in the last 6 months, of course, it has underperformed, but it is taking support at the 100-day moving average as we speak. Berger Paints is the other one. I've just pulled up the stock because there's a lot of OI build-up with regard to the stock in today's trade. The stock has been trading above all its key moving averages, 18% higher, holding up to the gains as well, 1% higher, telling you that there is some bit of long position which has come in today's trade for something like Berger Paints.
Okay, let's get in a couple of corporate conversations going. The markets are looking wobbly, but Narayana Hrudalaya is amongst the companies that posted a strong set of numbers in the fourth quarter FY19, which was aided by the consolidation of their Cayman Island operations. Darshan spoke to Viren Shetty, the COO of the company, about the growth prospects of the company going forward. Listen in.
So we did have a very strong quarter in the Cayman Islands. We had a lot of growth coming in from our doctors operating in other islands, as well as additional medical tourists coming in. But that's not the whole story. We also had a very strong performance from our mid-market hospitals. These are a hospital in Shimoga, in Raipur and Ahmedabad that historically were poor performers and have swung into the black. And going forward, we believe that this growth can sustain, and aided by government programs like Ayushman, as well as the sort of maturation of these hospitals and the kind of specialties that they can do. We believe that the growth is quite sustainable over this next year.
What about the trajectory of losses in some of the newer hospitals? When can that be expected to come into the black now?
Sure. We have 3 new hospitals, 2 in Delhi and 1 in Mumbai. The Delhi hospitals, one is a greenfield hospital. This is our hospital in Gurgaon. It's a world-class hospital built for medical tourists. New hospitals generally have a 3 to 3.5 year break-even, and this being only in the 8th to 9th month of operation, we believe it will continue for a while. Our other hospital we acquired was a running hospital called Dharamshila, which is in East Delhi. This hospital was almost at the break-even level, but we made additional investments in manpower that will mean that it should take within this year for it to break even. Mumbai hospital, again, is a children's hospital, and this is a super specialty hospital built to be a center of excellence in pediatrics for this part of the world. Like I said earlier, it will have a 3 to 3.5 year break-even period, and so we expect another 2 years for that to happen.
What about the existing hospitals? What's your plan ahead in terms of these hospitals? How do you see growth coming in there?
Sure. So our three oldest hospitals, two in Bangalore and one in Calcutta, they don't need any additional capacity for growth. The growth that comes from there will be through a changing case mix. So they've invested a lot in getting transplants, in doing very advanced cardiac surgery, in getting new devices such as LVAD and TAVI implants. These, we believe, will be the growth drivers for them going forward. Whereas the hospitals that came after that, they have a lot of additional capacity. Most of these are between 50 to 60% occupied. So volume growth will be what drives the growth for the non-flagship hospitals.
What's the debt situation? What are you looking to reduce debt?
Sure. Right now, we have a net debt of around 800 crores. We believe it will stay steady in the year going forward. We have a capex plan for around 150 crores while we're able to pay off a similar amount. So we don't see it shifting significantly either upwards or downwards.
Okay, post the fourth quarter earnings in the conference call and in a couple of analyst reports, I did read that you're looking to improve the EBITDA margins by various ongoing measures. Can you highlight what exactly are you doing and by how much improvement will all this lead to?
Sure. The simplest is simply volume growth. The more patients and beds that we're able to fill up, the more you're able to cover up our fixed cost. That is the most direct thing that we will be doing. The other things are we will be looking at a lot of the specialties that may be contributing less to our ARPOB and probably realigning it so that we invest more in specialties that are higher ARPOB. Like I said earlier, we are investing a lot in clinical transplant programs and very advanced cancers, which we believe will do a lot of work towards improving the overall EBITDA for our units. The other is there are certain excesses that a large organization has developed over the past 20 years, and those we will be looking to streamline. For example, using a lot of IT, we're able to offshore a lot of operation that physically required manual operations, like back office work or whether it's admission and billing. So certain measures that we will also be taking towards streamlining the existing operations to improve the EBITDA.
My last question, Viren, is what's the expansion looking like for FY20? What's the capex that is planned for that?
Sure. So the theme for capex expansion for this year is adding oncology. We have an existing multi-specialty hospital in Raipur. Our partners will be adding a bunker and we will be adding the linear accelerator and so convert that hospital into an oncology hospital. We will be doing the same thing for our hospitals in Jaipur and Ahmedabad as well as in Cayman Islands. Not all of it will be done immediately. Some of these are more back-ended towards the end of the financial year, so not too much of that expense will be realized within this financial year. But it's mostly a very moderated capex expansion. We aren't looking at any acquisitions for this coming year, and we believe there's enough growth that we can sustain from the existing operations.
Well, moving ahead, let's talk about a small cap company with a market cap of nearly 250 crores. Salasar Techno Engineering had a good fourth quarter. Increase in execution of orders aided the revenue growth for the company, which also led to an expansion in margins compared to last year. Let's discuss the quarter gone by and the outlook going ahead with Shashank Agarwal, who's the joint managing director of the company. Hi, Shashank. Good afternoon to you, and thanks a lot for joining us on Bloomberg Quint. For full year, your top line has grown by about 30% and the bottom line grew by about 14%. Would you be able to maintain this run rate in FY20 or do you expect to do better?
Well, in terms of the top line, probably will be growing at around 15% as the business looks good. It could be even higher sometimes at about 20%. And as far as the margins go, I think margins have improved during last quarter. And we hope that we'll be able to maintain these kind of margins going ahead as well.
So the last quarter, that's the quarter 4 of FY19, the company recorded margins of about 12.4, which is on the higher side if one were to look at the last 4 or 5 quarters. Going ahead for entire FY20, would you look to maintain these margins or it will hover about in some range of between 10 to 12 that one has seen in the last 4 to 5 quarters?
See, we've been maintaining an EBITDA margin of about 11% or so. The last quarter being probably one of the good quarters in the sense that the volume of production was high because of the dispatch pressures from all the sectors, and overall cost of manufacturing was less. and we were able to maintain the economies of scales, the margins, of course, were slightly better. But for the whole year, of course, ideally we would like to maintain that, but it won't be possible to maintain exactly probably at about 12%, maybe around 11.5% we should be able to maintain our EBITDA margin.
Shashank, what suppressed the bottom line growth is also the high finance cost that the company has seen for the full year. I guess the finance cost was somewhere about 16 crores. What's the debt on the books, and is there any repayment schedule in FY20 for that?
No, we don't have any long-term borrowings. These all are working capital debts, which is about 140 crores. And I mean, if you compare us with the peers, probably in terms of percentage, we are a slightly better place than most of our peers in terms of the percentage of the finance costs. Of course, in volume terms, in the absolute numbers, probably the cost of finance was slightly higher compared to last year. But last year should not have been taken as a benchmark because we had the IPO money lying in our account for some time, which we used as working capital. So the finance cost last year was slightly less, and it looks slightly, which has gone upward compared to last year. But going forward, probably in terms of percentage of the finance cost, we should be able to maintain these costs.
Okay, and taking a closer look at your balance sheet for last year ending March 2019, your trade receivables have gone up on year-on-year basis by about 39 to 40%. Tell us, what's the cash conversion cycle right now? Because it appears that it was higher in FY19. Will this continue going ahead, or do you plan to bring it down?
No, it will come down. In FY19, we completed a substantial part of one of our projects in PVNL for distribution, for rural electricity distribution. And there were a lot of payments which were held up, rather I would not say held up, they were slightly delayed, being the government project, because you require a lot of sign-ups, sign-offs and everything. We are targeting to complete, these projects in Q2 next year. This year, in FY19-20, and post-billing of the full project, the payments would start flowing in, and hopefully all the payments which are due, which has actually stressed the working capital cycles, they will probably come down by end of Q2 or so. So the cash flows would definitely improve. If you would look at the numbers of last year versus this year, probably the cash flow was slightly better.
Okay. Just last question, Shashank. What's the order book currently, and what's the guidance that you can leave us with regard to order book for FY20?
We have an order book of about more than 450 crores, which includes government projects as well as private telecom companies' orders. And as far as the guidance goes, we have been maintaining an order book of about 250 to 300 crores. And going forward as well, I don't think there'll be any dearth of orders, given that there is a very stable government at the center, and the focus of the government is on the infrastructure sector. And we being at the core of the affairs here, we are present in most of the sectors. So we should not have any problem in having a good order book as such.
And any new orders that you've bid for recently?
Yeah, we have bid for some orders in transmission sector in Haryana and in Himachal Pradesh, which are yet to open. But we have close to 250 crores of order which are already finalized in our favor from the government in EPC sector.
Okay, Shashank, we'll leave it at that note. Appreciate you joining us today and taking us through your last quarter earnings and also what one can expect going ahead in FY20. Well, that's the management of Salasar, Techno and Electric. But remember, the stock's not done too much actually on YTD basis. It has corrected. I don't know how liquid also this is. Promoter holding is somewhere about closer to 75%. As you can see on your screen, in the last, on YTD basis, the stock has seen correction of about closer to 39 to 40% leverage.
Well, the results, two companies that we spoke to, the numbers pretty interesting. Let's wait and watch what happens to them in the quarters ahead. Time now to get a market voice, a view from Morgan Stanley Annual Investors Conference. Darshan caught up with Sameer Baisiwala, India's pharma and real estate analyst, and started off by asking Baisiwala to share his key takeaways from the conference.
The healthcare companies are concerned, given the trailing 3 years of recent history, where there were more challenges than opportunities. The tone is definitely cautious. The tone is definitely, they need to be walking very carefully. But having said that, different companies will have a different outcome over the next 2 to 3 years. It just depends whether your pipeline for the US is ripe or not. So that really is defining companies one versus the other. And second important point of focus, I would say, is on the specialty side of the business. This is something, a new theme for the Indian companies, where they're graduating from generic business, now moving up to biosimilar and then to the specialty side. And we have seen a couple of large launches done. Large in terms of promise, but in terms of execution right now, it's still early days. So these are the two important themes that we're seeing here at the conference.
Okay, what's on real estate? Because I believe there were a couple of large real estate companies that also attended the conference. What's the company outlook like? Are they confident of on-ground sales happening? What is that they told you?
Yeah, so I would say companies are a lot more inward looking. So they clearly see the outside challenge in terms of demand. So they are getting much more frugal about cost. They are being much more savvy about their balance sheets. So that's something that's in their control, and they are trying to do best over there. And then they look out for the business. Most companies have the pre-sale target into fiscal 20, which is a reasonable growth over fiscal 19. So let me put it this way, when we talk of a sector in general, we see that maybe there's degrowth or maybe there's a low single-digit growth in volumes. But when it comes to specific companies, these are the larger ones, branded ones, well-run companies. So they are going to get disproportionate benefit out of this. So they would all be growing 10 to 20% actually.
Okay, let's start with healthcare. The fourth quarter season just got over. You have the full year numbers also. What's your personal assessment? How did you see this FY19 for pharma companies?
Yeah, so FY19 to my mind looks like when the fundamentals were bottoming out. And going forward, as we look forward to fiscal 20, 21 and 22, actually 3 years forward, I think we are getting much more constructive on the sector. First of all is the US business versus 3 years that we have seen mid-teen sort of price erosion. It's now coming down to mid to late single digits, so more, call it 7 to 8% price erosion for the base business. And that's easy to understand because that's the customer consolidation is behind us. It's only supply-led price erosion that we are seeing. So at the margin, things are getting better. Second, for the US, what is very critical is that they should have the pipeline of complex products ready to fire. And some companies are getting into that point where they've got 1, 2, 3, or even 4 new launches lined up over the next 12 months. Those are companies which would do better. So the commentary and the outlook is far more constructive than what it was.
Is it getting difficult because of the new norms, and it's been there for the past few years, the new GDUFA norms. The US FDA is saying that we want to start getting more and more companies, the drugs generic. Is it getting difficult for Indian pharma companies now to operate in the US?
No, so
in terms of pipeline, I'm taking in terms of future pipeline.
So I would say, Darshan, that it's both good and bad. So the good part here is they are the beneficiaries of the volume market share gain. So they are gaining market share. So versus 10%, I would say 12 or 14 years back, moved to 20, now it's almost 35% volume market share. So Indian companies are actually gaining it, and that's a trend which we see over the next few years as well. As we see American companies and European large ones, Taiwan, Malaysia, etc., who have all started to have site closures and defocus on the generic side of business. So therefore, it's a good outcome for the Indian company. The challenge here is that the pie itself is not growing too much. So that really is a key bottleneck. And to address that, people have to get into the complex part of the chemistry, of the devices, of the products. So these are inhalers, complex injectables, so on and so forth. Companies who get to them first are going to do well.
Okay, so we'll talk about specialty drugs, biosimilar, but just a sense, because I was speaking to Cipla a while ago, and his sense is that the new margin. So my question to him was that are the days of 30-35% margins or 25% margins gone? So his sense was that the new normal probably will be 20-22%. Is that something that you are sensing, that margins probably will stay under pressure for the next few quarters?
So I think it would play out different for different companies, and I don't think there's one specific number for the sector in general. And
it's just general that margins probably will come down by 400-500 basis points. That's the new norm. Is that something that you would accept? That's my question, not relating to Cipla, but as a whole.
No, so I would probably disagree on that, in the sense that margins have already come off to the extent that you said, 500-600 basis points.
Okay.
Here on, we expect stable margins to actually growing margins. And that's a function of your product mix, of your revenue mix, of your geographic mix, and then how much is a resolve to get the cost out. I'll just give you one specific example that a lot of these companies have 10 to 13% of sales as R&D expenditure. And there is no products or no launches to show for that. So either there's no pipeline, and if that's the case, then the research spend will come down to 5%, and you will actually have a release of 500 to 700 basis point positive on the margins. Or there is a very solid pipeline which would fire as we go along. So therefore, because of better product mix, again the margin should go up.
So what side are you believing could happen? Would they go in for higher spends, or would they curtail? Because we've seen in the fourth quarter that a lot of companies actually curtailed the R&D spends. What would be best for them?
Yeah, so both the things. So not all of this R&D spend was being productively deployed. Some of them were, I would call it, experimental in nature, because they would try to do specialty, some biosimilars, some other stuff, vaccines. So some of them is not working, or they can't afford to do those experiments anymore. And so therefore some of this is going to get slashed, and we had seen early trailer of that in fiscal 19. We'll see more of this as we go forward. At the same time, the generic spend, which was there, which was highly productive, we're going to see some of these play out through new launches and better launches in the year go by. So therefore, there should be better revenue mix, and there should be better cost control as we go forward.
Okay, let's talk about biosimilars. For you, for one, have been rather bullish on companies that focus on biosimilars. You think that valuations are a concern for some of these biologics company? And what I've read recently in some of the publications that have come out is that there is high prices erosion that's happening in certain European biosimilars. R&D spends are obviously much higher for biosimilar company. Will the payback be as lucrative as it was, or what it was envisaged?
It's precisely in the search of these questions that we took upon this pretty comprehensive biosimilar work the second half of last year. And I would say we came out very, very positive on this biosimilar theme. Let me just summarize it for you. It's a late cycle innovation, and so therefore versus chemical entities which came in 60s, 70s, all the way till last decade, we had seen generics launch all these years. However, biosimilars came in late 1990s or early part of last decade. So all of this are losing patent protection now, and so therefore the big opportunity for the biosimilar companies. So there's a new theme which is going to get played out. Out of $260 billion biotech industry, I would say $60 billion is going to open up over the next 7 years till 2025. So far, again, it's a little bit misunderstood. Outcome has been very good, which is by 2018 they had grossed $3 billion in revenues between just 6 products or 7 products, which means $400 to $500 million per product. And as you know, it takes about $100 to $200 million for them to get one product to the market. So my guess is with just 1 year's sales, you are more than breaking even on these products. So I think it's a good opportunity. It's a place to be in.
A lot of companies in their presentation and in their conference call do speak about going in for the specialty products. We've seen Sun already do it. When do you think that that will start reflecting? Because it's at a nascent stage right now. When do you think on an active basis it will start reflecting significantly in the financials?
So I think we are all waiting for that. It should have already happened. It hasn't happened. So it's taking time. There's a big and long learning curve linked to that. So hopefully over the next few quarters we should see a gradual ramp up. I don't think we are looking at hockey stick anytime soon. That's point number one. Point number two, it's all linked to the unmet medical need that these products bring to table. And if the innovation quotient is not very high in these products, it would be a longer drill for them to get to any three-digit top line number. So I would say 2-3 of them have already fizzled out. Have not done too well. Companies are sort of selling them down or defocusing. 2-3 of the larger ones are still in the play, and all eyes are on them. Hope they do well over next 1 to 2 year time frame.
What about the pharma ancillary space? What's your sense of if you track the hospitals or the diagnostic space? What's your outlook there?
So I think hospitals in particular is coming from a 5-year capex cycle behind it. So they have created a much bigger capacity to earn, much bigger platform, which is 40-50% bigger bed counts than it was before. They've diversified to multiple cities, metros, and to multiple locations per metro. So I think that's a good bit diversification, but at the cost of balance sheet and leverage, which went a little out of control. And as you know, it takes about 3 years for the break even to happen. So in this 5-year journey, we are at the end of capex, and some of the earlier hospitals are now turning profitable. Okay. So over the next 3 years, we expect this EBITDA momentum to be much stronger, and companies are focused on delivering on ROE. They're taking a step back from any fresh capex. So net, it should be a much better cash generation for the hospital sector over the next 3 years.
If you track the diagnostic space, do you find the high concentration of unorganized markets and these players, and we spoke to several players, and they were of the sense that, it will be only a volume growth game because they are not able to take those price hikes. Is that a concern for the diagnostic space?
Yeah, and I would subscribe to that view that over next 1 to 2 year time frame, competitive intensity is very high. You rightly said that 90% of them are smaller, unorganized players, so it's very hard to compete on pricing over there. It remains a volume game. But I think diagnostics and actually the whole healthcare in India has got a 20-30 year of growth ahead of it itself. If we compare to any other relevant emerging market like China, I think India can double every 7 to 8 years. Diagnostics, drugs, hospitals, everything. We are a young population and affordability is low. So therefore the longer term outlook, the longer term growth runway is very good. But in the near term, yes, we are expecting a mid-teen sort of a growth, largely driven by volumes.
What's the theme do you watch out in the real estate space in FY20?
So I think real estate has, everyone has a view on that, and rightly so, and different people see it from different vantage points. My guess here is that there are few pockets of big oversupply, and no price for guessing that. One is NCR, and the second is Mumbai. Here we live and work here, and you can see the amount of build out that's happening. So these pockets of oversupply will continue to be sluggish. Why? Because customers have seen it. They're getting deeper discounts. They are in no hurry. They don't see prices rise. So luxury and oversupply areas are the ones which are going to struggle. Outside of that, if you look at metros in South India, East India, actually North India, should be pretty okay. So we are expecting them to grow at maybe low single-digit volume growth. That's our outlook for fiscal 20. As far as prices is concerned, I think there's been 3 years of lull. Prices have not gone up. I think they may start to inch up, if for nothing, to mitigate the cost inflation.
Okay.
So that's the outlook for fiscal 20.
So basically, we spoke to some these property consultants like an Anarock or a JLLM or a Knight Frank. The sense that the data that they provided and the sense that we're getting is that among all the metros, Bangalore somehow seems to be, seeing much more growth. The inventory levels have come off, the commercial spaces pick up. Is that the sense that you're getting also, that probably, and you spoke about the South based company, that probably that belt will be better placed than the Mumbai based or the NCR based?
Yeah, absolutely. So I think I would subscribe to the view that Bangalore is doing well. But I'll just point out that the inventory, to my mind, unsold under construction units is probably one of the highest in the country. If I'm not wrong, it's around 70,000 units or so. But where it scores well is the fact that the sales is also one of the highest, so 8,000 units. I'm just counting in the organized sector and the bigger ones, which makes it a 10 quarters of inventory. So in relation to demand, yeah, sure, inventory is low, but in absolute terms, it's pretty high. Now, to complete the triangle, you got a commercial side, where the take-up is the highest in the country. I think India does about 34, 35 million square feet a year, and Bangalore is taking the largest part of that, close to about 8 or 10, much more than NCR and Mumbai, which just means that there's employment creation is much higher. And it's also South India sort of a capital. It is also political capital of Karnataka and so on and so forth. So demand dynamics are pretty strong over there, which will then play into the residential market. So therefore, we remain optimistic about Bangalore. It's just that the absolute inventory is probably the highest.
Okay, Samir, always a pleasure to speak to you. Thank you so much for speaking to Bloomberg Quint. So that's the Morgan Stanley view on two important sectors, the healthcare and the pharmaceutical sector, as well as the real estate sector, from Samir Baisiwala of Morgan Stanley.
Interesting conversation across hospitals, healthcare space, real estate and others. Must tell you the market is not interested too much today though in a lot of these themes because it's down and it stayed lower like this for the better part of the day today. It's been just that kind of a day wherein any kind of bounce, even the smallest of bounce, has been met with selling. Ruchit Jain of Angel Broking joins us with his thoughts. In a bit we'll also get in some other experts going. Ruchit, good having you. Afternoon. Thanks for joining in. What's your sense today, Ruchit, on the Nifty? Let's start with the Nifty, then we'll move on the Nifty Bank as well. What's the trade that you would initiate?
Hi, very good afternoon, Neeraj. Well, if we see last 3-4 trading sessions, then the markets initially had shown a bounce back move from its 20 days exponential moving average support of 11,770. But again, what we have seen that in last especially post the election results, markets have touched or crossed the 12,000 mark almost 3 to 4 times, but we have not seen any sustainable up move above that. So this is a clear indication that as of now, we are undergoing a time-wise correction within an uptrend. And in today's trading session, if you look at some of the options data, then 12,000 call option, 11,950 call option, and now during the second half of post noon, even 11,900 call option have seen significant built up in open interest of tomorrow's expiry. So this is an indication that for next one trading session and for till tomorrow's expiry, the index may not be able to give a crossover above 11,900 or 950 range. So I think it's very difficult to take a trade in the index as of now because of this time-wise correction. So definitely I think one should focus more on stock specific front rather than taking any trade in the index. As far as Bank Nifty is concerned, there has been some underperformance in Bank Nifty in last 4-5 trading sessions, and within this underperformance, 11,400 to 450 range has become a very strong resistance. Even if you look at options data of Bank Nifty, 31,400. Even if you look at the options data of Bank Nifty, then around 31,300, 31,400, all these call options have been witnessing a good amount of writing in today's trading session. So I think we have a limited upside for next 1 or 2 trading sessions, and we would see this consolidation phase, which can be termed as a time-based correction.
Okay, so do stock-specific trades and not necessarily the index. Keep in mind when we speak of specific stocks, just before we get into those, I just want to mark a few names. Now, it's not just Indiabulls Housing which is correcting thick and fast, which is down another 9% today. Lakshmi Vilas Bank too is down 10%. So keep that at the back of your mind. Indiabulls Ventures is down about 5.5%. There is weakness in J&K Bank yet again, so another 11% lower, which is the top loser on the Nifty 500. And Eros International, of course, continues to grind lower. But the Indiabulls Group, Lakshmi Vilas Bank, Shriram Transport, Biocon, Eros, all of these under serious stress. What are the specific stocks that you are recommending in the session today, Ruchit?
So we have a couple of buy ideas, but since we can see a lot of volatility on the stock specific front, and not on the index. So we are recommending to go long through options, because that would limit the losses even if we are wrong. So one is the buy call in McDowell. United Spirits have been witnessing a positive momentum and outperformance in today's trading session. Now if you look at the recent chart, then the 200-day moving average has always acted as a support on pullback move in last 1.5 months. Today the 200 there is an attempt to cross above the 200-day moving average, and if it successfully manages to close above the 200 DMA, then we should see a follow-up move in United Spirits in next few trading sessions. So 580 call option is now trading around 11 rupees. We recommend to go long through that on that call option with stop loss below 3.75, expecting target around 22. And Bank of Baroda within the PSU names is trading at its good support, the 200-day moving average, along with the 61.8% retracement of the previous up move is placed, and the prices are trading around that support. So we are expecting a pullback move in short term in Bank of Baroda. The pullback move is expected to go to up to 127, 128 kind of levels, but no, we are recommending to go long on 125 call option, which is trading around 2.70. One can go long in this for target around 7 rupees.
Okay, so some option strategies as well from Ruchit. Ruchit, just one quick question before we get into Dalmia Bharat, and that's our stock in focus today. But just a question on Indiabulls Housing Finance. Is the correction done, or do the charts indicate that there could be more downside?
I think charts are quite bearish, frankly, because if you see last 3 trading sessions, the volumes on this correction are very high, and usually whenever you see prices going down with high volumes, then those stocks usually tend to underperform in near term. Now even the pullback moves that were seen in the month of March or in the month of May, they had resisted around their 200-day moving average, and the price correction and have again resumed from there on. Now technically, if we see, then the first support for the stock would come around 575, which was the low made in month of February. But looking at the volumes in this up move, I think this 575 support would also get breached, and as according to harmonic patterns, we would find support somewhere around maybe 500 or even slightly below 500 levels. So clearly one should avoid any kind of bottom fishing over here just because prices have corrected. Let the prices show some side of strength or some kind of reversal pattern, then only one should look to enter. If any short positions are there, they should continue to hold the stock with a stop loss above 625 now.
Okay, so that's Indiabulls Housing and looks very, very wobbly in the session today. Okay, let's move on. Ruchit, stay on. So much more to talk about. A lot of conversation around cement. We spoke to India Cements as well in the session today about pricing and all. A lot of conversation about specific cement stocks. Dalmia Bharat, for example, that company shares started trading as Odisha Cement on January 26th. The stock price recovered marginally since then. Now, a retail investor may be worried about the sharp fall in the share price as well, but one needs to factor in the merger process and the resultant share distribution that took place. Nikki Michanan is here with those details and maybe a sense of what analysts believe the stock could do in the near term. Nikki.
Well, right, Neeraj, there's been a lot of confusion around the Dalmia Bharat share price. Currently, it's trading around that 1150 per share kind of level. Retail investors have been asking about why the share prices are lower as compared to the levels that we saw at the time of delisting, which was around November 28, around that 2,300 kind of level, and significantly off as compared to the 3,200 peak. Well, that's not a fair comparison to begin with. We're supposed to see, look at the share prices which are trading. The relisted date was around Jan 22nd, and the shares have actually got relisted at a price of around 860 per share kind of a value. That's a significant uptick if you look at the momentum has gained for the stock price thereon. And also we got to also count in the fact that it's also the merged entity now which has come into play, and it's 2 Odisha Cement shares which were being distributed for 1 Dalmia Bharat share. And just to give a fair math there, if you calculate the current market price of around 1150, multiply it with 2, which is the ratio which took place at the time of merger, you will be roughly around that 2,300, 2,400 kind of share price level. Even if you talk about analyst community as a whole, 20 analysts have been covering the stock, and all of them have buy rating. They've suggested a potential uptick of more than 14% on the stock, but just playing a little bit of devil's advocate here and weighing in the negatives on the stock performance, three things typically which analysts as a whole have been, and even the financials have been pointing out. First is the missing mutual fund units, which got a lot of which raised a lot of corporate governance issues. The mutual funds units worth around 3,444 crore were illegally or unauthorizedly transferred by the depository participant. These were being transferred from the demat accounts held by the subsidiaries of the company. The matter has been reported, and also criminal complaint had been filed to that effect. Investigation also has been initiated by SEBI, and appropriate action is yet to be taken. Second, also there is a regulatory overhang because the company yet awaits a final NCLT approval coming in to acquire Murli Industries. Is yet to envisage or earmark any kind of capex plans for FY20. And the third parameter, which is also concerned for the company right now, the volume growth, which is it's not growing or is behind the industry average. For FY19, the growth stood at around 10% as compared to the industry growth of around 13% due to clinker availability issues. And going forward too, the management expects a growth of around 8 to 10%, which is a shade lower than FY19 number, mainly on account of the kind of election and the floods that we've seen overall in that region.
Okay, thanks so much for that, Nikki. So that's of course Dalmia Bharat cement and some conversations around that stock. But cement as a pack has just started to wobble a little bit. Nothing as compared to some of the NBFCs, to be honest, but has started to wobble a little bit in trade today. In trade, the other one which has looked decidedly weak today, Navneet, is autos, and almost all stocks, at least in the large cap arena, are trading with cuts. Not deep gashes, but Bajaj Auto, Maruti, and the works. Every stock has a shade or tinge of red to itself.
That's right, and I think one stock which is standing out, not exactly auto, but the auto wang, that's Motherson Sumi. After
the upgrade.
The upgrade, plus last week it touched 52-week low, but since yesterday, there is an upgrade. The stock has seen some bit of, it has bottomed out. That we have to see that, but from those levels of 111 or 112 it saw last week, it's gained about 6 to 7% now, and we've got a lot of buy calls, in fact, coming in on Motherson Sumi. Technically, also from a lot of analysts, Neeraj, we've been interacting since morning.
Okay, Ruchit, you want to come in? One, Motherson Sumi, and two, any of the large cap auto names, if they look more wobbly than what they are right now?
The thing is, rightly said, Motherson Sumi has formed a support around its recent low of 112. But for a confirmation that the stock has bottomed out, we need at least one high top, high bottom structure or an up move supported by very good volumes. Then only I think we would get a confirmation of this 112 being a bottom. As of now, it seems a good support. So any long positions can be held on. One can expect this bounce back to extend towards 127 and 135 kind of levels. And 112 should be the stop loss on any of the existing long positions. Now, as far as the other large cap auto names is concerned, Neeraj, we have seen a sheer underperformance by most of the auto names. You look at the month of March, we have seen a very decent pullback move from lower levels in most of the sectors, but Nifty Auto Index has been one index which has shown an underperformance. Although it is trading around its weekly 200 average support, but we believe that at least for next 2 or 3 months, we would see some sort of corrective phase, which may be a time-wise correction, but at least there are no signs of an up move in near term. So clearly, one should avoid any kind of bottom fishing in auto stocks if one is looking for, at least from short-term trading perspective.
Okay, so that's of course the view on autos. The other, of course, is what's happened to two groups, right? One of them is Indiabulls, and we spoke about that. The other one is ADHG and PwC, and the whole saga between the auditors and the company. Reliance Capital, that one is down about 7%. Reliance Home Finance too should be soft in trade today, and with reason. PwC is now resigned as a statutory auditor of Reliance Capital and Reliance Home Finance, and this is despite the company saying that they will pursue some legal options against the company, which is what I think a lot of experts or in different audit firms found a bit strange. At least Gautam Naik did, and I'll just get his sense in a bit. We'll just make you hear what he said in a bit. But this is Reliance Group's response that they do not agree with the reasons given by the auditor, that they have convened the audit meetings as well. This is as per Reliance Group's response. And they have duly responded to queries as well as letters. Having said that, for the auditor to go out and take such a step and eventually now resign as well, it's something that investors probably are not too sitting favorably with, as a result of which those stocks have corrected. But as I said, we spoke to some experts, including Gautam Nayak. He's partner at CNK and Associates. He points out that the free flow of communication between the audit committee and the auditors is very, very crucial.
It's a very unfortunate stand that a company has taken in this case. Communication is always through the company, and therefore it's essential that the company provide a free flow of communication between the audit committee and the auditors. Now, in this case, I think it appears that that was not happening, according to the auditors. Now, that's something which is a matter of concern, because that clearly showed that the company had something which they did not want to get in touch with the auditors on that. Other aspect is of threatening the auditors. Now, that is something which is absolutely uncalled for. The auditors are merely doing their duty, which is required to be done under law. Now, for that, you can't threaten the auditors that we may initiate legal proceedings against you.
Of course, we have a special show lined up today at 4:30 p.m. on the big four audit firms and credibility crisis that they are facing here in India. You wouldn't want to miss that discussion. Well, I mean, a good thing that we've spotted though today is that crude prices have come off further. Now about 2% intraday fall for crude prices, 2.5%, and Brent trading near 60. And this should be viewed marginally positively. I don't know if the market is in a mood to view that in that vein, nor are some specific stocks which are the oil sensitives, but this should be viewed positively. Let's wait and watch what happens here as far as crude goes, and therefore the resultant impact on BPHP, RC and some of the others.
That's right, Neeraj. In fact, crude correction is a very big tailwind for the Indian markets, but considering today's reaction, what we've seen in the markets, we're not taking any good news, so to say. But remember, crude prices have come off significantly in the last 2 weeks at least. They've corrected nearly 13 to 14% from the highs that one had seen this year. It's now inching very closer to the mark of, that's the Brent crude price on your screen, 60 to the dollar. Okay, time to bring in our fundamental guest on the show. We've got Jagannadham Thunuguntla of Centrum Broking who's joining us on the show. Hi Jagannadham, good afternoon, and thanks a lot for joining us today on Bloomberg Quint. Markets have corrected sharply. We're facing that resistance towards the 12,000 mark. Though you talk to any analyst on the street and they are of the view that the momentum is actually there on the upside. How are you approaching the markets right now? Would you use these dips to buy into any stocks or sectors?
Purely as a fundamental analysis point of view, if you closely look at the major missing link in the whole puzzle is earnings. Make no mistake that in the short term, the liquidity or FII money can help momentum on the upside, but eventually if there is no support from earnings, it becomes very difficult for the markets to sustain higher levels. And the just concluded earnings season has been quite muted earnings season, with the non-BFSI segment posting barely 7% earnings growth. Even the BFSI shown tremendous growth. That's because of the low base effect they had in the previous year because of the high provisioning that they created. So understandably, till the time that earnings don't come back, the Indian markets will appear highly overvalued in comparison to emerging market peers, as well as in comparison to the historic trends of Indian market itself. So till the time that overvaluation that doesn't get settled down, I think it becomes very difficult markets to have very sustained rally. Having said all that, I think there will be stock specific opportunities that will bound to come. There are many mid cap and small cap opportunities trading below 10-15 PE multiples. I think one can be very stock specific, but make no mistake, for Nifty probably upsides may be limited.
Jagannadham, what should a shareholder in any of the Indiabulls Group stocks do right now, particularly Indiabulls Housing Finance, but even the others?
In general, I think one is as we speak, I think there are so much data flow and news flow that is coming. If you're already stuck in any of these stocks, probably you will have to keep a watch on these and then watch the development. But important point is that if you are building up a long-term portfolio, building up now many stocks are available at very convincing valuation. One way of looking at is bite the bullet for once and take the pain and then move on, to some other better names. I think we don't have coverage, so it becomes difficult for me to comment any on stock specific things, but I think sometimes it makes a lot more sense moving on to other names.
Okay. So move on from the Indiabulls Group stocks, even at the current prices, and move on to the other names. I think that's the advice that Jagannadham Thunuguntla is giving. Would the same hold true for a Yes Bank, Jagannadham, or is the story slightly different there? Fundamentally, what would you do with a Yes Bank?
If you look at the financial statements, FY19 just concluded financial year. Yes Bank book value is at 116, meaning thereby at 135 rupees, the stock is barely trading at 1.2 times historic book value. Can you believe it? And based on the FY20 or FY21 estimates, already the stock is trading at sub book value. That means currently the market is trading the Yes Bank as good as any PSU bank. That's quite unbelievable even 6 months back. Keeping all that into account, fundamentally speaking, the stock is appearing undervalued. Of course, there are two major challenges now. One is till the time the bank can raise fresh capital, it becomes difficult to justify the future growth. And if the company has to go through a QIP issuance, as the management had indicated, the major challenge is it has to come at a discount to the current market price, meaning thereby the upsides on the stock may remain capped. So I think till the time that QIP issuance happens, one can't expect a great amount of momentum on the upside, but you have to believe and hope that book value of 116 will be respected at least.
Yes Bank continues to reel under pressure. And remember, Moody's has to place the bank under its rating review for downgrade, and stocks now seeing cuts of about nearly 3.5% as we speak, around the levels of 134 to 135. In fact, the stock has been witnessing some shorting even on the futures side. Let's move ahead. The panel set up to look into RBI's capital allocation framework, which met today, wants to hold another meeting before finalizing and submitting the final report to the government. Nikunj Ori, who was covering the meeting, joins us now with the details. Hi Nikunj, wasn't this supposed to be the final meeting? What's changed?
This was supposed to be the final meeting of the ECF panel, which is going to decide how much reserves the RBI should hold on to its books. But now there's a change. There's going to be one more meeting before the panel headed by former RBI Governor Bimal Jalan finalizes its report. However, the panel is not seeking any extension and will submit its report by end of June. That's what a panel member has told reporters. And he has also said that there may be differences in opinion amongst panel members, but that is something which is being discussed and will be discussed in the next meeting as well, before the findings of the panel, before the panel submits or finalizes its report. Over to you.
Okay, Nikunj, we'll leave it at that note. Thanks a lot for joining and taking us through that update, and shifting focus back to the markets now. We're still trading below that 11,900 mark. Remember, just briefly, we reclaimed that mark, but there is selling now, which is coming in even at the 11,900 mark. 80 points lower for Nifty. Bank Nifty is seeing cuts of about 1%. One or two stocks which have stood out in a weak market like today's, and it has been the steel companies, but particularly Tata Steel. It is still maintaining its gains and sitting with gains of about 2 to 2.5% as we speak. Jagannadham, any thoughts on the steel companies today? Specifically, we've seen companies like Steel Authority, Jindal Steel and Power gaining a bit, but what are your thoughts in this space?
That is purely as a tactical trade. Market is betting that the China may announce a stimulus, or they would like to do something to keep their economy running after the onslaught of US trade war. In that backdrop, metals are having a relief rally. But we should remember that US-China trade war is appearing to be more deeper than it is appearing on the surface. Meaning thereby, till the time that settles down, it may be difficult to expect sustainable rally in the metals. Probably this may be a good tactical trade to bank upon, but not beyond.
Okay, stay on, Jain. So much more to talk about. Let's take a slip into a quick break. As we hit into that break, here out Pramod Gubbi was speaking to us earlier on the day about pockets and the size of the companies that he's betting on.
I hope they're doing the right things, and I hope we are near a solution. But from an investing perspective, I think at least from our fund philosophy perspective, we will not bite these unless and until most of the issues are behind. You know, if we take a call now, that will amount to some sort of speculation. Because we have very little information of what's happening inside. All we can do is decipher as to what's happening. So maybe if things are sorted out, you will get a better opportunity to get in. Better in the sense, not from a price perspective, but from a risk perspective, right? There is certainty of a recovery, and then you know, you can definitely invest in these stocks. But at this stage, I think it's too much of a gamble to look at these stocks.
Okay, are you looking at autos actively, Pramod? And the bigger question, and the debate rages on about whether this slowdown is structural in nature or cyclical in nature. And while we hear an RC Bhargav saying that from August the demand will bounce back, I don't think anybody, except for maybe the auto companies who are experienced, I don't think anybody is equipped enough to say with certainty that I know for sure that this is structural, or I know for sure that this is cyclical and it will bounce back. I don't know, how do people make those comments in the first place?
Yeah. I mean, absolutely right. I think there's a mix of both. There is an element of cyclical slowdown. Clearly, auto is one sector which thrives on credit supply. And given the credit supply slowdown in the last 6 or 8 months, you would expect a slowdown of these sorts. But then, this is almost unprecedented. We haven't seen this. It's not like we haven't seen a liquidity crisis in the past. So there could be an element of structural aspect as well, be it, the car ownership itself. There is plenty of data in the Western world which suggests car ownership levels are going down. We are seeing anecdotally millennials in India are also being averse to car ownership. So there is an element of that, but I don't think things have changed so dramatically that we're seeing a 20% decline year on year. So the truth, like always, lies in the middle. It will eventually recover. The question is, once the recovery happens, what sort of companies will benefit from it, right? Because in the whole macroeconomic growth situation, we tend to ignore the competitive or the industry structure element of it, right? So there are various new competitors coming in, particularly in passenger cars. So passenger car category as a whole might recover, but does that necessarily mean that you go ahead and invest in companies? I think that's a very incomplete investment case. So you'll need to watch out for new entrants coming in, what sort of product positioning is happening, so that once the recovery comes in, do the listed companies actually benefit from it?
Yeah, actually, I wonder, Darshan, Pramod, both of you, I mean, if car ownership is a question mark and if shared mobility is a truth, then hitherto, I mean, at least my experience in the last few days, there are a number of Tata cars which are making a bit of a comeback in the Ola Uber fleet as well, and therefore would Maruti have as clean a runway in that segment as it probably used to have in the past?
Could be, I don't know, because right now no one knows, because a lot of and especially I think most of the cars Ola Uber I have seen are Toyota cars. I haven't seen much of Ola or Uber go in for a Maruti. Probably there could be some Wagonars, but I think a lot of other options are also available.
Also emerging.
What's your sense of which sectors are you inclined towards? If you're saying someone has to invest for, let's say, 2 or 3 years, which are the right sectors that they should start accumulating, and which is the sector that it's a clear avoid for you?
Well, I mean, we invest from a bottom-up perspective, so we go wherever there is structural visibility of earnings from a long-term perspective. And at this stage, assuming that the economy remains by and large in the same shape, I think consumption and private sector banks would rank high up the order from our pecking order perspective, because it is the demographics which is a given in some ways, and the demographics will ensure that the consumption growth will remain stable, albeit through some cyclical ups and downs. That's one clear visibility of growth. In fact, even if an investment cycle were to come back, the bigger beneficiary will be the consumption story, because that will lead to job creation, income generation, disposable incomes going up. So whichever way you look at it, from a safety perspective or from a growth perspective, consumption will remain right up our pecking order. Alongside that, I think some well-run private sector banks, again because of the structure of the financial system in this country, we've seen the issue of public sector banks giving way to private sector banks. We had the NBFCs come in and take some share in some categories. Even that is, we've seen a pullback now. The mutual funds which stepped in, they're also pulling back. So that leaves a fairly open space for private sector banks, which have had a very strong history in terms of managing asset quality. At the same time, very strong hold on CASA deposits, which pretty much underpin their ability to cherry pick assets without having to take extra risk. So those two sectors remain high up our order. I think what to avoid at this stage, like I said, unless and until there is a recovery in investment cycle, anything related to that, we'd hold off on, be it construction, real estate, metals, commodities, and so on.